All right. Hi, Rosemarie. It's so good to have you back. I'm so glad that we get to discuss again about the pre-approval needs of a first-time home buyer or a buyer that has blemished or um, maybe a unique financial situation. So here we are back, and I have 5 questions to ask you, but they kind of maybe overlap a little bit. So I appreciate you being here. Now, for anybody who doesn't know, Rosemarie and I did a part one to this podcast, and we'd encourage you to go to that one before coming here because you'll find out a lot of information. Um, but Rosemary has decades worth of knowledge and experience in the mortgage industry, and she really is an honest person with high integrity. And I'm so blessed to call you friend. So here we are, Rosemary. Um, I think one of the things is that we discussed in that first podcast was the importance of starting with knowing your finances.
Mhm.
That would mean your gross income and what you can actually afford in a house. But I want to ask you, is it even possible to get a mortgage with poor credit?
Yes, it is possible. There are so many different mortgage programs available. Now you've got generally the agency loans, which is basically Fannie Mae, Freddie Mac, um, FHA, VA, USDA. Those are the agencies. Those all the credit score requirements vary by product, but not only that, they vary by lender. In fact, I believe FHA allows credit scores as low as 500,
Oh, wow.
but lenders don't.
Right.
What lenders say we're not going to lend to anybody under 600 credit score or 620 credit score on the agency products. So credit scores vary based on, minimum credit scores vary based on the program. However, just because you've got the credit score that qualifies doesn't mean it's going to be approved. They have something called automated underwriting, where you go in the computer and then you click, and then the computer tells you whether it's approved or not. However, garbage in, garbage out. Customers apply online. They go put what they believe is 100% honest information. But they don't know what they don't know either. For example, many years ago, I was working with a commission salesperson, and I was asking her for her tax returns. I said, well, I really need to look at your tax returns in this case to know how much you qualify for. And I was on the phone with her. She said, Rosemarie, I made $80,000 last year. Is that enough to buy a house? I said, well, yeah. But what she didn't realize was that commission employees need to have a 2-year average. And she didn't have the 2-year average. So whereas she told me the truth in her mind, that was not the qualifying income that I could use in order to qualify her. Now, eventually we did get her a loan, but that's just an example of customers not knowing what they don't know. So they put in their income. Well, they're doing a lot of overtime. So last month they made, $8,000. However, that $8,000 may not be sufficient because they don't have a history of overtime for 2 years, for example. So even though customers are honest when they're filling out the application online, assets is another example. I have $50,000 in the bank. 50,000, that's what they put in. 2,000. However, 45,000 of that just came from a large deposit on the bank statement that I see. So now since I have to prove every dime of the mortgage, even though they have 50,000, if that 45,000 of the 50,000 that they had in the bank just came out of their mattress, I call it mattress. Nobody keeps money in their mattress, I don't think, but I call it mattress money. If it's in the safe deposit box, if it's in the safe at home, if it's saved at your mom's house, none of this money I can use to qualify the customer because I can't verify an acceptable source of cash to close. So when people, even though people are completely honest, when they're getting a pre-approval and they say, well, my credit score is 680. Can I get a mortgage? Well, 680 is certainly a qualifying score for some of the mortgages, yeah. But can they actually get that? Is there, for example, if they have something on their credit that is, for example, let's say they got a 680 credit score, but they had a bankruptcy last year. Okay. Well, unless it was one of those that you repay, Chapter 13, I believe, you had a bankruptcy in a year, you don't qualify for a mortgage. So just because your credit score is acceptable doesn't mean credit is acceptable. But yes, there are programs. They also have other programs that they call non-QM, non-quality mortgage, qualified mortgage. Those tend to permit lower credit scores as well, although not like they used to. So yes, it's possible to get a loan with bad credit, but your options go lower, the lower your credit score. And I really haven't seen anything under 500 get approved.
Okay. So I've got a 500 credit score. What do I need to do to improve my credit?
Good question. When customers don't know what their credit score is, or they don't, or they just not familiar with their credit. One of the things that I do before asking them to apply for a mortgage is to go to www.annualcreditreport.com. And once a year, or if they've been declined for financing, they are allowed to get a free credit report that don't have to put their credit scores in it. They don't have to put a credit card in it at all. And what I offer is like, you go get the credit report and I will review it for you. Okay, it doesn't give me a credit score, but it gives me the actual credit report that I can look at and evaluate. Now, there are some things. Credit repair is a totally separate industry. I am an expert at mortgages. So although credit affects mortgages, I'm not an expert in mortgage repair. And there are a few things that I can do. I can look at the credit report and find all of their balances are real close to their max. Well, a good way to increase your credit score in a heartbeat is to pay down those balances. And when I say a heartbeat, usually until the next billing cycle. So there are simple things that I can say, pay down your credit. And I know that's going to increase their credit score. But then there are other things like collections. Sometimes, depending on how it's coded in a computer, and I don't know details about that, but sometimes paying off a bad debt can actually lower your credit score.
Yeah.
And the reason is because they show it as new activity on a bad debt. So there are ways in mortgage financing that you can keep your collections open. The lenders make an adjustment. They'll take 5% of the balance and use it as a monthly payment. So if their debt ratio is in line, their monthly debt is in line with the guidelines, then they if the monthly debt is in line with the guidelines, then they can or under, they can afford to add that 5% of the collection.
Right.
But they might not necessarily be able to. But that's why what I do is I'll take a look at it and say, okay, this is above my pay grade. Okay, you need somebody who's an expert at it. And I recommend credit counseling. However, good luck with that, because credit counselors, they just use the laws that are currently available. to help the customers remove the stuff that's not supposed to be on there, the mistakes.
Right.
But they also use the laws to get the stuff off the credit report for a time being because the creditor didn't report in enough time, quick enough. So if they don't
Mhm.
report in 30 days, it comes off. But then if they find reasons, find evidence why you still owe that, it goes back on. So
Right.
that can be dangerous because it's off when I run the credit report. And then when I get at the right at the end, we're ready to close. Lenders all run an additional soft pull on the credit report to see if anything's
Mhm.
changed.
Right.
So I had a
So,
customer that went through credit repair and he paid off all the stuff and his credit score got sufficient to get a particular loan program. And then right before closing, we ran it, we found a new collection. So we got a new collection. We had to rerun the credit report to get the new score. The new score came out lower because of the new collection. And that particular customer was very fortunate that first of all, the credit score was still acceptable for the program,
Mhm.
but he ended up having to pay more money to get the same rate because the interest rates are also dependent on credit score.
Yes.
So in this case, this man he wasn't on purpose. He thought he paid it off, but there was a $4 balance. So when the bill came, he just disregarded it because he thought he already paid it. And the $4 balance caused a collection that ended up costing him, I don't know, $2,000 more to close on the house.
Yeah, those are the nightmare situations that oftentimes happen because, we're not prepared. Um, you know, the
In this case, it was just an oversight.
right.
He knew better than to mess up his credit while he was getting a mortgage. He did not do it on purpose.
Right.
He missed it. It was an innocent mistake. I mean, there's
Right.
other things that can happen. People can get laid off. I had
Right.
another customer that had two jobs and she quit one of them that I was using as income to qualify. But
Mm,
and she didn't tell me because she was already approved for the mortgage. But we found out at the end, and she goes, "Well, I was already approved." I said, "Yeah, but now you're not." you know. So
yeah.
I mean, we did close that. I mean, her husband got a raise, and it worked. It worked. But it's important that customers don't mess with their financing until after they're closed.
Right. When you talked about credit repair, and there's a lot of industry stuff out there about credit repair and credit fixer and different things like that. And the caveat to that is this, is that if you're looking to buy a house 6 months down the road, start your credit repair, you know? But if you're looking to buy a house sooner than that, it may not be a good thing. Just because, again, you talked about the 30 days and then the credit report company can put it back on. And there's times that the credit report company doesn't honor the request, such as you can have them take off all of your old addresses. You can request that they do that. But if they don't honor that request, which that improves your credit score if they'll take them off. But if they don't honor that request, sometimes that can diminish your credit score. So you've got all of these little idiosyncrasies that you have to deal with credit repair. So if if you are looking to repair your credit and you have stuff on there, one of the big caveats that I know was told to me was do not pay off a loan, a credit card, um, eh, but pay it down to a certain percentage, like 33%. Um,
Well, I don't know all the percentages, but
right,
if you
right,
were to pay it down to like 10%, that might be a different thing. The important thing to know about that is don't close the account.
right. Absolutely. That was a big one. Don't close the account. Okay, so um I want to kind of switch a little bit here. um, to uh, knowing how much house we can afford. Because sometimes we could be pre-approved for X amount, but in reality, if we get X amount, let's say $260,000,
Okay.
okay? But in reality, we don't feel comfortable, or maybe we want to have a little bit set aside for improvements that we might need to make. So we don't want to really go to that 260,000. We want to maybe stay about 180 to 200,000. Um, Talk to me about that.
Well, as a lender, when a customer comes to me and they say, I want to buy a $160,000 house, but these people are qualified for a $220,000 house. It's generally the practice is to get them approved for more than they need. As I'll tell you, I get them approved for 180, they're going to want 192. Okay. They're going to see a house that's 192, or they're going to see a house that's 180 that, that there's a bidding war, right?
Mhm.
So instead of trying to rerun findings every time, which they might be at 8 o'clock on a Saturday night, and if I'm not by my desk, they might lose the deal. Okay. And although I've got a real flexible schedule and I'm available a lot, I'm not on call. Okay. So we try to approve them for more. Now, I generally do a little trick with the computer and I put in extra fees so I can get them approved for a higher monthly payment. But when I'm estimating costs, for example, on 180,000, it's going to be different than it is going to be on a 220. And if they don't want to go that high, telling them they need this much money when they only need this much money is not very helpful. So I kind of rig the system. I get them approved for a higher payment. Like I'll put more money in for property taxes. And
Mhm.
then, but I'll calculate the money for what they're looking for. That way, in a heartbeat, I can figure out, can they qualify for that house that's a little bit higher than 180 that I wrote them up for? Well, as long as the payment's under this, I can. Another thing that comes into play is property taxes and property insurance, because that's, and homeowners association, if it applies, because all that goes into the housing expense ratio and thereby the debt ratio. So if I'm getting somebody approved for 180,000 house and I'm using 3,000 in taxes, but really it's in a really expensive city
Mhm.
and those taxes are 5,000, then I'm not accurately representing the house payment. So that pre-approval is not right. So I'll ask them, what city you planning on buying in? Now, if I'm familiar with the city, I can kind of guess, or I can look them up online, see what the other house is going. And I usually work with a real estate agent. So what taxes should I use? Okay, what property taxes? So I try to get a property tax that actually matches the area that they're looking at and the price range what they're looking at, but it's never going to be the same because the way lenders use property taxes in general is they use last year's taxes.
Right.
However, if that person whose house you bought has been in that house for 20 years, at least in Michigan, their property taxes are going to be way lower than you're going to pay the next fiscal year.
Right.
Because in Michigan, at least, your taxes are capped when you're a homeowner from the primary residence exemption. However, when you sell that, it becomes uncapped. So it's based on the current sales price. Well, if I bought my house for 116,000 and now it's worth 230,000, those people are going to be assessed based on the 230,000. They're going to get payment shock the next year. However,
Yes.
lenders only have to use the current taxes because it's not our job to predict what they will be. However,
Right.
it's a good idea to know your taxes are going to go up.
Absolutely. It's a very good idea to know your taxes are going to go up. And that's a very valid point in looking at what your mortgage payment is going to be, because it is sticker shock when you get the next year and they do an escrow analysis and you end up paying 2,000 more that year. That's just it's crazy, and it's like, whoa, wait, what happened? What happened? And I like how you said, the person who's owned that house 20 years, they locked into that rate on what they paid for the house. You're paying more, obviously, than they did 20 years ago. So that's a really good thing to come across. And insurance goes up.
And it
Rarely,
just
rarely does
recently
it
went
go
up
down.
all
Yeah.
over the board.
Yes.
I was like, I call my insurance guy. I'm like, what? What?
Yep.
1,500 a year? Are you kidding me? It used to be 600 a year or
Exactly.
900 a year.
Exactly. And you're like, what in the world? And of course, that when they do the escrow and the insurance rate goes up, your escrow payment goes up. Talk to me a little bit about, I know with most of the people who are going through agencies will end up having their money for their taxes and their insurance put into an escrow account, and that's a part of their mortgage payment. Um, when can uh, is it viable and feasible to separate the mortgage payment and pay your own insurance and taxes?
That depends on the loan product. On conventional loans, you can waive the escrow account if you have at least 20% down. There's usually a fee that's included in the interest rate. So it's a little bit higher discount points, maybe a quarter point, maybe an eighth of a point. It's not a whole excessive, but if the lender doesn't collect your escrows, you are higher risk, because if you don't pay your taxes, the government can come up and snatch up the house. And I believe their lien supersedes the mortgage lender's lien.
Yes, it
So
does.
lenders don't like that.
Mhm.
Generally, this is just recently changed. Used to be, I called up and I said, I want to waive my escrow after I've already had the mortgage for a while. And they returned my escrow account and I paid my own taxes and insurance. Now they charge like $250 in order to do that,
Mm.
in order to change from an escrow to a non-escrow. And I don't know if that's true with every servicer, but that's what I have seen at my own servicer.
Right. And it does require too that you have been paying for a certain number of years in order to
I
even
think and I could be wrong because I'm not an expert at servicing, but I think it's generally they look at it 1 year and you have
money
to have an
now.
on-time
Okay.
payment. Yes. Yes. So they can say yes or no. But FHA, for example, VA, you got to have an escrow account.
Yeah. There's no.
Non-QM loans, sometimes you don't.
Mhm.
Um, so it just depends on the program, but the escrow account is, it gives the lender a little bit more, less risk. So it gives them more comfort. And that's the preferred way of doing it. And personally, I have an escrow account again. I refinanced. I said, okay, put the escrow account in. And to me, it's just easier to add 1/12 of that to the payment than write that whole chunk out of the check twice a year. So
Yeah. Yeah. That is true. There's benefits both ways, you know. Um
some people
but
don't
it's
like it
important.
because they say, well, that's the money that they could be making in their bank account as interest. And I say, I haven't seen a bank pay more than 1% in a while. I don't know. They're like, well, we're not paying anything because look at how low the interest rate. And then the interest rate goes up and then we're still not paying. I'm like, okay,
Okay.
whatever. Credit card rates are still high. Why aren't savings rates? But I would believe that that's a totally different discussion that I'm not really qualified to have.
Absolutely. So we're going to go ahead and continue with the questions. We're running out of time. But I want to say, what do we do after we get a pre-approval? Do we go look for houses? Do we contact a real estate agent? And how do we find a real estate agent that has our best interest? What are the things we want to look for?
After you have a thorough pre-approval, and that means somebody's actually collected your documents and reviewed them, and
Mhm.
you will know that often when they ask you for more paperwork. Okay, I got your bank statement. Now I need this. Okay, I got your income. Now I need this. Then you know they reviewed it. And if they've got the expertise to review it and they've got the paperwork, Your next step is to start looking for a house. How do you find a real estate agent? I highly recommend people go to people that have worked with other people that they know. I highly recommend personal referrals. Yes, you can look in the line. Yes, you can see all the advertising for this team or that team. You see the billboards, okay? Good advertising, great. However, do you have a relationship with that? Are you going to work with the top guy? Probably not. Okay. Yeah, yes, you'll have access to his expertise, but you're probably not working with him. So go with somebody who you have experience with, that you know personally, that you trust personally, or somebody else that you know does. That's the best bet in my opinion, because number one, or your lender personally ask me who to go to, because I work with real estate agents for decades in Metro Detroit. Okay, I'm going to turn you on to one that's doing a lot of business, but also doing business the way I like to do business. And the benefit of that is twofold. Number one, somebody else has got experience with that person, but number two, it's the potential leads. If Mary gives me a referral to a customer, that customer is more important, because not only do I need to satisfy that customer so I get future leads, I need to satisfy the referral source.
Mm-hmm.
Okay, because Mary gives me a lot of referrals. So if I don't do a good job with this customer, I could not only lose this customer, but everybody else that Mary's going to refer to me.
Right.
So I highly recommend that. And absent that, then, you can go to people, just this real estate agents all over. You can go to an office and you can walk in, you can meet with them, you can interview them. Say,
Oh, I
yes,
love
I'm
that.
about buying a house. I'm talking to a few different realtors. And then you can ask them about their experience. And experience is not always the right answer. Okay. Because there are some people that have less knowledge that can give you the kind of service you want because they got their boss to go to or whatever. It's important to be able to communicate and trust to that other person.
I love that answer. We are, like I said, running out of time, but I love having you on, and I'm looking forward to the next time that we can be together.
Me too, Mary.
All right. You take care.
Thank you.